Hey there everyone, it's Chad Pavel, CPA here, and we've been getting a lot of questions and a lot of interest around single member LLC taxes with an update for 2021 and 2022. Now, we know a lot of people are becoming entrepreneurs. So if you're starting your business for the first time, if you're a sole proprietor, or if you're even still an employee and you're really curious about how taxes work when you become a single member LLC owner, or even a sole proprietor, then this is definitely the video for you. All right, so there's a couple of big components to taxation when you become self-employed, and there's actually big differences between being an employee working for another company where you get a W-2 paycheck and then the earnings and the income and all of the requirements that you're going to have to track your finances and file and pay taxes once you become a business owner. So I've created this walkthrough in response to a very popular video, How to Pay Yourself and How Taxes Work as a Single Member LLC. We created that back in about a year and a half ago, so we're definitely due for an update. So let's jump into all the details, and hopefully I can clarify your questions around single member LLC taxes. So the first thing to note is that single member LLC owners have several key tax requirements. You need to know about these before you start a business, and if you've already started, and whether you started in 2021 or 2022, you're definitely coming to us at the right time. So if you miss these important tax items, you could actually face thousands of dollars in very painful unpaid IRS and state tax bills, IRS and state tax penalties and interest, letters, liens, levies, and garnishments, where you'll get threatening notices from the IRS or your estate. They can actually take money out of your bank account. We want to help you avoid all of these painful problems. And worst of all, if you do things illegally, meaning if you primarily don't file tax returns and don't report your business income at all or properly, you could face jail time. Tax evasion is an absolute no-no. So if you have any doubts, you should always be recording and reporting your business's income. You should be taking the proper deductions. So if you have any doubts, always know that you must file a tax return. An individual tax return every single year, and a business tax return if you have a separate business, or a Schedule C, which is part of your individual tax return. Never fail to report your income. That is a big no-no. So here are the three tax items we're going to cover in this video. One is the concept of pass-through taxation. Number two, we're going to review the single member LLC tax forms that you must file each year, how to pay yourself as a business owner, and then estimated taxes and filing deadlines as well. And we're going to use a couple of rough examples to give you some illustration on how these various items work. So as a quick refresher on individual taxation, individuals, meaning single people, married people, and even their kids, file what's called a Form 1040. That's the U.S. individual tax return. Now, individuals, again, married or single, file this form. They either check the box for single or check the box for married filing jointly or married filing separately. On this form, this is where you report all of your income as an individual, as a person, or as a couple. You report your salary, which is your W-2 paycheck that you get from your employer and maybe from your own business if you're a corporation. You record all of your interest and dividends from your investment accounts, all of your capital gains and losses from your investment accounts, from your real estate, and from any other assets that you sell. You will record income from your pensions and your IRAs if you're retired and taking income. You'll also record your Social Security benefits and any other income sources you have, gambling, lottery winnings, any sort of income that you earn in the year, and of course income from S corporations, LLCs, and from your sole proprietorship. So all of that combines into your income, and that's what you file on your tax return. Now, different sources of income have different tax rates. Capital gains has short-term and long-term. W-2 income is taxed one way. Your pass-through income is taxed another way. But in the end, all this income is reported on your tax return, and that generates a tax due. And then you pay the tax if you hadn't paid estimates throughout the year. Here's just a quick refresher on tax rates. This is the 2022 tax bracket for single filers and married filers. So again, all of your income is totaled up, and there are different tax rates for different sources of income. But in general, here are the tax rates for individuals and married couples. And keep in mind that these tax rates are actually graduated in the sense that you don't just pay 32% tax if your income as a single person is between 170 and 215. You pay 10% tax on the first $10,275 as a single filer. 12% on your income between $10,276 and $41,775. 22% on the next bracket, and all the way up. So your average tax rate is going to be lower if you're earning $180,000 in this example. As a single person, your average tax rate will be less than 32% because you have those other brackets of income that are taxed at the lower rates. So that's very important to know. So let's cover pass-through taxation. What the heck is it? You've probably heard the term. You might be a little concerned, a little confused about it, so let's clarify right now. So when you think about pass-through taxation, you're primarily referring to income that you earn through your ownership of LLCs, single member LLCs, multi-member LLCs, which are taxed as partnerships. There's also partnership, that's a separate entity that's not an LLC, but they're both actually taxed the same. And then you have S corporations. Now, so the important thing to note is that these three buckets, LLCs, partnerships, and S corporations, don't actually pay federal tax. If the business earns $1 million, the S corp or the LLC doesn't pay the tax. It doesn't have its own tax bill for that $1 million in income. That $1 million in income actually gets allocated to all of its owners or members. And so basically, if a business earns $1 million, the members and the shareholders ultimately pay the tax on the income that they own from those entities. And the income that you will have allocated to you is based on your percentage of ownership. 100% of the income from these three different types of entities flows through to the individual tax return that we just showed you before of all of the owners. And so the owners ultimately pay the tax bill. Now, C corporations are quite a bit different. The C corporations range from small businesses all the way up to public companies. They pay their own federal tax, 21% flat federal tax plus state tax. So those corporations actually have their own tax return and pay their own tax to the IRS and to various states. But then the shareholders are ultimately taxed again on their individual returns if those corporations pay dividends or interest to the shareholders. So if you own a C corporation, you don't own any LLCs or partnerships or S corps, and you're probably going to have a W-2 salary from that corporation that gets reported on your individual return. And if you pay yourself dividends, those will also be taxed, the dividend tax rate on your individual return. So C corps are very different. They do not have pass-through taxation like LLCs and S corporations do. So hopefully this clarifies how the income flows from pass-through entities. So next, single member LLCs do not file a separate corporate tax return. Only S corps have a tax return, C corps have a tax return, and partnerships, including multi-member LLCs, have a separate business tax return. But again, C corps pay their own tax, S corps and partnerships pass through income to their shareholders and their members. But single member LLCs do not have a separate tax return, but there is a special form. Because you do not prepare an additional tax return, you actually have what's called a Schedule C. And that's a profit and loss from business, and you include this schedule in your individual tax return. So it's not quite a business tax return, it's a 2 or 3 page document that shows the profit or loss that you'll ultimately include on your individual tax return. And then again, you pay the tax on the LLC income and any other sources of income that you earn throughout the year as you normally would on your individual return. So wait, probably have some questions. I have an LLC, not a sole proprietorship. Is this correct? Yes. Sole proprietors, meaning you earn a 1099 income or you don't have a separate LLC, you simply earn income as an individual. And single member LLCs, they actually file the same exact form. They're taxed the same way. There's no tax differences between a sole proprietor and a single member LLC. Single member LLCs and sole proprietors file the same exact tax forms and pay the same exact taxes as each other. There's really no IRS differences at all between the sole proprietor setup and the single member LLC setup. Regardless of what you've been told, simply having an LLC doesn't save you any tax or give you any tax benefits versus staying as a sole proprietorship. The primary difference is in asset protection if you have a single member LLC, and that's for the attorneys here on YouTube to talk about. Here's basically how it works. Let's say you have a company and so you're a single member LLC. Each year, when you file your individual tax return, you're going to prepare this schedule on the screen called Schedule C, profit or loss from business, in parentheses, sole proprietorship. They're taxed the same. Here you'll include your revenues and all of your expenses, and that will result in a taxable net income. In this case, we're going to use $100,000 as the net income base for discussion. That $100,000 in net income literally just gets added to line 8 of your individual tax return in the 2021 form. So just imagine you've got all sources of income. You're going to have an extra $100,000 sitting on your individual return. In this example, I'm going to assume that your spouse has a W-2 and they earned $90,000. We're going to put that right there. Let's also assume you had $0 in interest and dividends to keep this simple. Let's say you sold some stock and you had $10,000 in taxable gain, no pension or IRA, you're still working, no gambling, lottery, or other winnings, so that's $0. But again, your single member LLC generated $100,000 in net income. So if you combine all this income, the $90,000 from your spouse's job, the $10,000 in capital gains, and your $100,000 from self-employment, your total income is $200,000. So let's assume on this individual return, your taxes due are $40,000. But wait, there's more. Just like Kevin O'Leary, the shark, has always said on the show. You also have self-employment tax as a single member LLC. And that's because the federal government still needs its share of payroll taxes. And that is Social Security and Medicare tax. The total is roughly 15.3% up to a certain amount, but on a $100,000 income, it's 15.3%. So when you're a W-2 employee of a company, the company and the employee split that 15.3%. On your paycheck, you'll see 7.65% of your income going to Social Security and Medicare. Your employer pays the other half, and that's a deductible expense to them. The total is 15.3%. And the bigger difference is that tax plus your income taxes that you choose to withhold are automatically withheld on your paycheck. The payroll company calculates those based on the information you put into the payroll system, and they send it to the IRS, and they send your state tax to the state every couple of weeks. And so that's how the IRS and the states get their taxes, and payroll companies calculate that for you. When you're self-employed, the LLC owners have to pay both taxes, the 15.3% combined. And single member LLC owners shouldn't and should never take a W-2 paycheck. You actually cannot. It's not allowed. And so what happens is LLC owners have to pay the entire 15.3%. And so in this case of earning $100,000, you've got $100,000 in income, but you also have $15,300 in self-employment tax that you pay to the IRS. So that's how the IRS keeps their tax income coming in. The IRS gives you a deduction of half of that 15.3%, which is the 7.65% that employers pay. So you still get a deduction on your income, but you still pay the tax. Basically, you need to pay this plus your regular income taxes to the IRS, either when you file your income tax return each year or when you make estimated payments, which we'll get to in a few minutes. Let's go back to the example. We had $90,000 in W-2, $10,000 gains, $100,000 income from your single member LLC. That all gets added to your income on your Form 1040. Now, you did owe $40,000 in tax before we had self-employment tax. You also have $15,300 in additional tax that you need to pay to the IRS. And so your total tax due in this rough scenario is actually $55,300. Now, there are many different deductions that we haven't talked about here, but in this example, you actually owe $15,000 more in taxes because you're self-employed. And that's something that a lot of first-time self-employed people do not understand, that they have more tax they need to pay in addition to the regular income tax that their business income generates. So as we continue on here, how do you pay yourself as a single member LLC? Well, you're going to pay yourself the exact same way that a sole proprietor pays themselves. You do not take a W-2 paycheck. If you have a W-2 right now and you're on ADP or Gusto or some other payroll system, you need to stop that. You need to call and make an adjustment. You can't do it as a single member LLC owner. You take what's called an owner's draw. and you do not get a deduction for your owner's draw. You can't deduct your own pay. You're paying tax on the whole net income of the business. You record your draws not on the profit and loss. Again, it's not a deduction. You actually record it in the equity section of your balance sheet if you have a QuickBooks account. And so basically, it just doesn't appear really anywhere on your Schedule C, because your Schedule C is only a profit and loss statement. So again, if you have a W-2 right now and you're a single member LLC and you're not taxed as a corporation, it's actually not allowed. You need to talk to your CPA about fixing that. But you can pay yourself really in any way you'd like out of your single member LLC. You can write yourself a check, send yourself an ACH, a Venmo, a wire. You can take cash out of the business. It's really flexible. You can also pay yourself as frequently as you want. You can pay yourself quarterly, monthly, weekly, even daily. If there's money in the bank account, you can pay yourself. Now, obviously, you don't want to pay yourself more than you can afford. If the business needs cash and you want to pay yourself, you need to make that decision. But if you have consistent income and profits, you can feel free to take money out of the business as frequently as you'd like and pay yourself in really any method you'd like. You simply need to record it properly, which is, again, in the draw section of your balance sheet in the equity section. It does not hit the profit and loss statement. So let's talk about estimated taxes. Well, you owe federal and likely state taxes if you live in a taxable state equally throughout the year. Now, let's talk about why and then how to pay those and how to calculate them. You don't have a W-2 paycheck as a single member LLC owner. You don't have a payroll company who's calculating your taxes and sending them up to the IRS and the state. You don't have that anymore. So more or less, you voluntarily, in quotes, pay your taxes directly to the IRS and to the state. And that's where you hear about athletes and entertainers and self-employed professionals getting in trouble with the IRS for having back taxes because they don't go and pay the tax. You have to initiate the payment. Log into the IRS, log into the state website, and pay. And you can wait till when you file your annual taxes, but do you really want to have a $50,000 or $100,000 or $200,000 tax bill come April every year when you could plan and set that money aside and pay equally throughout the year? That's the better thing to do, and it'll cost you less in penalties and interest. Because if you wait to pay income tax and self-employment tax on all of your income in April, then you'll actually very likely owe tax and you'll owe penalties and interest because the IRS and the states charge you penalties and interest for not making those regular payments. And the larger the tax bill and the longer you wait to pay the tax or the estimates, the larger the penalties and interest will become and the tougher it will be to dig out of that hole. So here's how estimated taxes work. Again, you've got federal and you've got state estimated taxes and tax bills at the end of the year, so don't forget about that. Paying your estimated taxes is required in 4 equal installments throughout the year. And if you pay those and pay the right amount by the deadlines, you'll have little or no tax due at the end of the year when you file your tax return, and little or no penalties or interest. So these are due April 15th for quarter 1 of the year, June 15th for quarter 2 of the year, September 15th for quarter 3 of the year, and January 15th of the next year for quarter 4 of the year. And if those dates fall on weekends or holidays, they're a little bit flexible. But you can always have those dates by logging into the IRS website and looking at the dates. So how much do you pay? What is your tax? Your goal is to pay 100% of the actual tax you owe on your current year tax return equally throughout the year. The challenge is, how do you know how much you're going to earn if it's June? How do you know? Are you going to earn $100,000 or $200,000? You might not be sure. And so it's nearly impossible to predict it and calculate it to the exact dollar, but that's why estimates and some safe harbors exist. So in this example, we've got $55,300 in total tax that we owe. Let's also assume that your spouse didn't withhold any tax, just to make this really simple, meaning she or he didn't take taxes out of their paycheck. You owe $55,000 in total tax. In this example, you're going to want to split that into 4 equal installments for the IRS, and that's $13,825 per installment, and you want to pay that each quarter. You're going to want to set aside 25 to 30%, even 50% of your income to pay taxes, to pay estimated taxes throughout the year. Now, let's say that we've estimated that you owe $55,300 in taxes throughout the year, but then things fell off. You only earned $60,000 in income. You're going to owe less tax. So what happens if you pay that total $55,300, but you make less money? Well, then you'll get a refund when you file your taxes. Your other option is you calculate those taxes and you simply lower your quarter 3 or quarter 4 tax estimated payment to decrease the amount that you send in to minimize the refund. Because in the end, the IRS and your state are happy to take your money on a zero interest loan, and then they'll give it back to you when you finally file your tax return. But your goal is to get it as close as you possibly can to the actual tax bill throughout the year using some analytics and tax planning strategies. If you make more money, you had a great quarter 4, you made $250,000 in income, you might owe $70,000 or $80,000 in taxes. And if you only paid in $55,000, you're going to have to pay the additional tax plus some penalty and interest depending on when you file your returns. So you will owe more money. So in that case, you can safeguard yourself by putting in an extra estimated payment to get you up to the amount that you ultimately owe using that quarter 3 or quarter 4 tax estimate. So in the end, your goal is to send in tax estimates in 4 equal installments to the IRS and your state based on the amount of income you estimate you will earn. So the IRS and the states will actually give you some safeguards here to reduce or even eliminate your penalties and interest if you pay a certain amount of estimates throughout the year. There's 2 safe harbors. Number 1, if you pay 90% of the current year's tax throughout the year in estimated payments on time, you won't have any penalties and interest. So if your tax is, let's say, $100,000 due this year, because you had a great year, you weren't planning to, you made a lot more. But if you paid 90% of this year's tax estimate, meaning $90,000 of the $100,000, you actually won't have penalties and interest if you pay equally and on time throughout the year. Safe harbor number 2, if you pay 100% or 110% if you make more than 75 single or 150 married, if you pay 100% of the prior year's tax throughout the current year, then you will not have penalties and interest when you file, if you file timely. So it's kind of a moving target, especially if you're a new business and if you have other sources of income. But in the end, you're going to want to pay 90% of this year's tax throughout the year. And if you make a lot more money, you're going to want to send in an extra payment. Or if you pay 100% or 110% if you make more money of last year's tax, you can look at last year's tax bill and you saw that you owed $50,000, you can pay $50,000 or 110% of that this year and not have penalties and interest. Again, if you file timely, you got to have a good tax advisor to help you and some good tax software. You can plug in estimates. If you're making $100,000 through June, you think you'll make an extra $300,000, you can plug those numbers into certain tax software and they will tell you how much tax you will owe this year. And you can use those and update that throughout the year to calculate your ultimate tax bill before the year ends and make adjustments to your estimated tax payments. And so the safe harbor is whichever is the lower amount, believe it or not, 90% of current year, 100 or 110% of last year will keep you safe. If you pay more and you owe less, you'll get a refund, and vice versa. If you pay less and owe more, you need to pay tax and penalties. But in the end, again, it's nearly impossible to predict your income with 100% accuracy. So if you have drastic up and downs in your business, you're not sure if you're going to make $50,000 or $250,000 this year, consult with a tax advisor, and some tax software can help you if you want to do it yourself to get your estimates as accurate as you can and avoid those penalties and interest and pay the safe harbor amounts along the way. So here's how to pay your estimates. You can log on to the IRS and your state website and pay from your bank account or pay with a credit card. That's pay your estimates or your total tax due. You can also send in a form and send in a check. Last year's tax return, just look at the bottom. It should have a form 1040-ES, and that is your estimated payment vouchers for quarter 1, 2, 3, and 4. So if you have any doubts, look at last year's individual tax return, look at the estimated tax forms, and those should have actual numbers on them that are tied to the safe harbor that you're going to want to pay. All right, everyone, post your comments below. I'll make another video about the specifics. I know there's been some questions about how to specifically work with state taxes. There's 50 states, some of which are not taxable. The tax rates are very, very different. You might have some questions around how to calculate your income. You might have some questions around what happens if I have a job or two with a paycheck plus a Schedule C. How does all the income and how do all the taxes work? Post your comments below and don't forget to subscribe.